Hey everyone, welcome back to Corporate Decoder. Today, all just filed a current report and I am seeing one red flag that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is talking about estimated catastrophe losses, and there is something here that tells us about their risk management approach. Alright, so what we have here is basically an update on Allstate's estimated losses from storms and other disasters in June of 2026. They've posted this information online and it is part of this filing. Now, why is this important? Well, Allstate is an insurance company. Their whole business is about taking on risk, specifically the risk of these kinds of catastrophic events. How they estimate and manage these losses is really key to their financial health. Looking at the details of what is registered with the SEC, we see various types of securities that Allstate has on offer. This includes their common stock, which is what most people think of when they hear Allstate stock. But they also have debentures, which are basically long-term loans they've taken out, with a fixed interest rate that can change later. They also have preferred stock, which is a bit different from common stock. Think of it as a hybrid between a stock and a bond, often paying a fixed dividend. Specifically, there are Series H, Series I, and Series J preferred stocks listed here. These are all different ways the company raises money and manages its finances. Now, let's dig into the core of Allstate's business, which is their common stock. This filing confirms that their common stock, with a par value of just 1 cent, pairs hair, is traded on the New York Stock Exchange, or NYSE as it is commonly known. They also mention trading on NYSE Texas, which is an interesting detail. It means the stock is available on multiple platforms, potentially increasing its accessibility for investors. The ticker symbol for their common stock is all. This is the main way most investors interact with the company. This filing specifically references a press release from the 16th of July 2026. This release is the actual announcement about those estimated catastrophe losses. While the filing itself is brief, the attached exhibit, the press release, is where the meat of the information usually lies. It is like getting the summary in the filing and then the full story in the appendix. And at the end, we have the signatures. Eric K. Ferrin, who is the Senior Vice President, Controller, and Chief Accounting Officer, has signed off on this report. This shows that the company's top accounting and financial officers have reviewed and approved this information. It is a formal stamp of approval from within the company. Now, looking at the bigger picture and some external context, Allstate stock has seen some movement recently. Headlines show it is up a bit, but also that some analysts believe is still overvalued. For example, one headline from the 17th of July says the stock is up 3.3%, but GF value still says overvalued with a GF score of 69 out of 100. Just a couple of days prior, on the 15th of July, another report mentioned shares falling 4.3% with GF value still indicating it is overvalued. This constant back and forth suggests mixed signals in the market, with some seeing value and others seeing warning signs. Interestingly, there was also news about a new chief financial officer being appointed, Christian Loan, on the 14th of July. Leadership changes like this can sometimes signal shifts in strategy or financial management. Allstate's PCIE ratio is around 2.1, which is quite low. A low PCIE ratio can sometimes mean a stock is undervalued, or it could indicate that investors expect lower future earnings. Their current price is also hovering close to its 52. Weak low suggesting some investor caution. So, what is the story here? This filing, though brief, points to Allstate's core business of managing risk. The estimated catastrophe losses are a direct reflection of their exposure to unpredictable events. When these numbers are high, it pressures their profitability. The fact that they are filing this shows transparency, but the real insight comes from how these losses compare to their reserves and their overall financial strength. It's a constant balancing act for insurers. The risk I am watching is how effectively Allstate can absorb these catastrophe losses without significantly impacting their financial stability. If these events become more frequent or severe, it could strain their reserves and require them to raise prices substantially, potentially driving customers to competitors. What I am actually looking for is a clear trend in their loss mitigation strategies and their ability to maintain profitability in the face of increasing climate-related risks. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, smash that like button and subscribe for more. Join our Discord linked below.